Hi, I'm Roy Zimmerhansl, and welcome to another Securities Lending Saturday Live. There's 28 trillion euro of securities lending available out in the market today. And while that sounds like quite a lot, that's not even a third of the assets that are available in the market. So if you've ever wondered why more investors don't do securities lending, then this is your lucky day, because that's what we're going to be talking about in today's show. So if you are part of the securities lending infrastructure, if you are a borrower, a lender, or you're just plain interested in learning more, then this is the place for you. So let's get started. Hi, everyone. There's quite a lot of people on already. I really appreciate it. As I said, we're going to be talking today about why investors don't lend. I've been speaking to investors about securities lending since 1984. So maybe I've just done a really bad job of it and haven't been able to convince them. But I think there might be a little bit more to it than that. What I'm going to be doing today is sharing with you my thoughts and experiences and comments I've heard from people and my own observations from over the years. As always, I've got my slide deck. Look, I have the only one who I can identify on the live stream so far actually is Clive. Thanks very much, Clive Shelton. Appreciate you being here. And I can see there's other people there, but unfortunately, LinkedIn weirdly sometimes just doesn't show me who is on or why. So if you're putting a comment in, that's great. I really appreciate it. Also, drop your name in so that I can give you a shout out and acknowledge your participation. As always, you can download the slides or access the slides from this show or the previous series. What you do is you go to this website, sign up for it, and over the coming days, my system will send out to you not just this week's slides, but previous slides. So if you're interested in getting those, go ahead and sign up. As always, what we do is we do the entire show will be live on LinkedIn and Twitter. But if you want to see the full recording, the recording will only be available on YouTube. That'll be available tomorrow from 3 p.m. UK time. And that's the channel on YouTube that you can access this video tomorrow and the whole sort of previous series from the 30 plus shows. Salah, thanks very much. Appreciate you being there. I'm not certain if this is your first time. If it is, great. If you've been here before, thanks for coming back. As any regular visitor and viewer will know, I always have a slide deck because it stops you from having to look at me the whole time. This is what we're talking about today, why investors don't lend and why most of them don't actually lend. There's a lot of different reasons, and let's explore some of them. First, we'll talk about just a quick recap of what we have been doing throughout the full series. This is week 32 out of, I think, 34, 35 previous weeks. So we're getting closer and closer to the 1-year anniversary of doing these things. And we covered a huge amount of topics. Today, we're talking about why most investors don't lend. Next week, we're going to talk about bilateral versus tri-party collateral. And that's been something that's been asked for, particularly and originally by Amel. So Amel, thanks very much for that request. We'll finally get around to that next. As always, the reason we really do this is because securities lending is becoming really a mainstream global activity. And so what I'm trying to do here in this series is share with you the views, thoughts, and opinions of other market participants, other investors, people that are outside the spectrum and inside the spectrum, that little circle of trust of securities lenders, and share with you my own views. What we're going to be talking about specifically today are the key areas that I think are why people don't participate. One is ethics. The second one is suitability. The third one, which people most commonly think of, which is risk. There's also a fourth one, which is where market participants, some asset managers, think it's a product differentiator to not be lending, to have it as a unique selling proposition. So a USP for them. We don't lend, and we'll look at that. And then finally, as always, it's about knowledge and understanding and whether there's a sufficient level of that today. So that's what we're going to talk about. As I said, what we're trying to do is Share our views and thoughts. If this video is helpful to you, give us a thumbs up or whatever platform you're watching it on. That really helps us attract more people to actually see it and share more information. And of course, if you want to make certain that you get every video, please subscribe and it'll be notified. If you ring the bell, it'll also tell you that a video has been released. We're still trying to get to the 500 number, because when I hit 500, then I'll be able to open up the community channel on YouTube. We've had a lot more comments and questions come up and get posted in that, so I really appreciate that. If you have any questions about this or other topics, please feel free to put them into the comments section, and I'll answer them usually within 24 hours. And that's great, but I'd like to take it a step further. If we can get to 500 subscribers, I think we're at 406 now. In fact, I know we're at 406. It's a bit of a lie, but yeah. So if we can get to 500, then YouTube opens that up for me. And if we just go back to the original slide, this guy here, we've had a vote from someone in the audience. They like this guy. I like this guy as well. We'll look at them probably first. Quickly, let's look at the numbers. So why do I say most investors don't put this chart here showing $103 trillion worth of securities are professionally managed under the global asset management community? It's from a BCG report, and that's from June 2020. So it's not, we haven't got to the, no, June 2021, sorry. June 2021 for end of year, December 2020. So in a few months, hopefully there'll be an updated BCG one, because you can see there's been huge growth. I mean, and there has been tremendous growth. And of course, markets have grown since the end of 2020, although we've had a little bit of a pullback recently. So if you have 103 trillion of assets under management, and according to the last ISLA market report at the end of the first half in 2021, you'll see that there was 24 trillion euro worth of assets available for loan. So I didn't take the 28 because I wanted to do like for. If you convert using the average rate of dollar euro through 2020, that comes out to about 28%. Now, the truth is actually the figure's lower than 28% because that doesn't count, for example, retail brokers going through a Schwab who are running their own account, or E-Trade or Robinhood or any of the brokers, the Webull and that. So actually, it's probably closer to say 25%. So only a quarter of institutional asset money is in lending programs. And now let's turn to why. Fanny, always great to see you. Appreciate you always being here. It makes a difference to me when people come back to visit. So I'm always happy when people come back. So thanks for that. So when we talk about the ethical elements of securities lending, I don't really ever come across anyone who in and of itself has a problem with the ethics of securities lending. Usually it's about feeding short sellers, those evil vampires who suck the life out of markets and companies. And that's what the real ethical concern is. In the show notes, I will point you to an article that we had as a guest blog from someone last year, where he talks specifically about the ethics of short selling. So I won't repeat that here, but I will include a link in the show notes. Really, the question that people really come up with is, why would I lend my assets to someone whose goal is to drive down the price of my asset? It seems counterintuitive. Why would I enable you to drive down my stock by giving you that stock? So there you go. And there's a few answers to that, and then I'll get to the question that Steve is talking about here. But look, one of the issues here is first of all, not all loans are for short sales. So all covered short sales do require a securities loan, but not all loans are for short sales. There is quite a huge and growing market for collateral transformation. And part of that is really turning assets that from a regulatory or a counterparty point of view don't satisfy collateral standards. So you're basically taking these securities and transforming them into assets that are acceptable. Now, the other thing about short selling, of course, is that not all short sales are really directional. They are in the sense that they do benefit if an asset price falls, but usually these are hedged transactions. So profits can be made whether the stock prices go up or go down because of the other side of the hedge transaction. And so it's really about the net profitability. So it's not always just about driving down the price. It's about the movement between the long asset and the short. The other thing is that many or most or the vast majority of transactions are for very short periods of time. So they have limited influence on the long-term outlook for asset values, and those will typically be driven by the fundamentals. So even if there's a short-term disruption, it doesn't really mean that the long-term value is impaired. And the best example of that, of course, is Tesla, which has had numerous and well-known and popularized short-selling attacks on it. Whether you think Tesla's a good company or not, the facts are that Tesla has survived it. The share price has thrived. And if you've been an investor that never loaned out your securities, or you've been an investor that was long Tesla and loaned them out, there's a big performance difference between the two of you. The truth is, why not get the money if the money's there? And then, of course, fundamentally, there's not always the fact that a short seller might be right. Typically, again, Tesla's a good example where there have been many short sellers that have lost money there. So just because someone wants to borrow your asset and short sell it, even if it's just purely directional because they think it's overpriced, that doesn't mean that they're going to be right. So it's still about the weight of the market. So look, those are the key things on the ethical point. I want to post up Steve's question here and just take a minute to go through that. One reason you don't mention is that some holders of bonds don't want to facilitate the shorting of those bonds, which they think depresses the price. But what they don't understand is that by lending, you allow more liquidity to take place. And it goes on, but unfortunately, I can't pick it up here. But Steve makes a great point. And in fact, we've seen that through all of the central bank activity and quantitative easing over the last decade. And again, Steve's more of an expert in this than I am, but let me just share you my view. What happened is as quantitative easing started and central banks started buying up typically their government bonds, what was happening is they became such big holders of their own bonds that it was actually distorting the operational efficiency of the marketplace. And so from time to time, you would get short squeezes on the bonds because there wasn't enough supply out there for people to access them. And so reluctantly, many of the central banks came into the market. And one of the reasons why they didn't want to do that is they didn't really want to see themselves competing with institutional asset managers. They wanted the free market to compete as it would, and they thought it would distort the fact that they would participate. And so that eased things, but only to a small extent. And as the QE programs ended up carrying on and getting bigger and bigger, they become even larger holders, and in fact were in some cases reluctantly forced into becoming regular market participants, making their bonds available in the same way as other market participants. And that really smoothed the operational workflows and settlement problems that come up from time to time. Look, is not, but certainly the liquidity of the market has been greatly enhanced by the return of those assets into the market. And I guess that's the essence of what Steve is talking about, because that's what we talk about when we refer to securities lending, helping grease the wheels and making markets more liquid and more operationally efficient. Thanks for sharing that, Steve, and hope you're feeling better, man. And we'll catch up soon. Salah, thanks as well for signing up as a new subscriber. Always happy to get new subscribers. We're one step closer to the community channel on YouTube, so appreciate that. If we talk about suitability, even me, who's been trying to get people involved with securities lending for forever, basically, even I don't think it's right for everyone. So let's look at some of these things. So when I talk about lending is not really for everyone, the truth is that not everyone has the operational infrastructure or thinks that the returns are right for them, or they're concerned about their access to the market or making their securities available. And a good example of this is something like small cap fund managers, where they might own 3%, 5%, 10% of a stock in a relatively illiquid stock on the exchange. And many of them have a concern that if they make their securities available, there's a limited amount of turnover in those securities. And by making their stocks available, they could distort the market and actually have maybe even a lasting impact on their securities. So on the share prices of their portfolio. So to me, that's a valid concern. Now, whether I agree with it or not, look, I think there's a reasonable case to be made for that, but it doesn't matter. To me, it's about the fact that they've actually, as long as they've investigated it and they've come to an informed decision, then it makes sense. So it isn't for everyone. And while they, as they say, fortunately, size isn't everything, it is a lot in this business. You need to have a reasonably sized position to participate successfully. Now, how does that work with retail investors? Which is a great question. The reality is that the Robinhoods and the other brokers that are involved in this business, they're able to aggregate multiple hundreds and thousands of customers that all have individually small positions and make them into institutional sizes. Size isn't everything, but you do need to have a certain amount of critical mass to make it worthwhile to participate. And of course, not every security is in demand. And so the majority of most people's portfolios are invested in main index securities if they're in equities. And if so, then that's going to be the majority of everyone's portfolios. And if everyone was participating in securities lending, that would mean that there'd be a huge oversupply. And in fact, that's a reasonable argument. I don't want to go into today's video, but in a future video, I'll talk about why I think that's the wrong way to look at it. But if you want to look at the number of Apple shares out there or Microsoft shares, the truth is there's a huge supply. We don't need more investors to come into the program. You're welcome, but the volume of short selling activity in those stocks is really well covered by the market. So I think if you're looking at supply demand imbalances, that's where you need to really evaluate the portfolio and see what the capabilities are and what the opportunities are in terms of revenue opportunities, but also in terms of risk reduction. Because while you could say that a stock is oversupplied, what that also means is that if you're an investor in Apple and your shares go on loan and you decide you want to sell it, so you need your shares back. The truth is there's many other lenders that can just satisfy your position. No market transaction needs to happen. So while the oversupply is a problem in one sense, because how do I get a share of the activity that's going on? It's also a great safety mechanism in the sense that there always are other people that can fulfill the sort of the coverage that you need to be able to get your stock back in time. So there is that issue. Now, Salah has mentioned a question here. Others are worried that they can't get the bonds back when they sell them. And particularly with something like a corporate, that's the kind of thing that impacted the government bonds where Steve was talking about and getting back to the liquidity question. That was really the point he was making. But Sal is also right that in particularly in corporate bonds, I've seen examples where it has been a challenge to get bonds because the corporate bonds in particular, secondary market trading liquidity can be pretty thin. It was made worse by regulatory changes that stop banks doing proprietary trading or discourage them from doing proprietary trading, because a lot of the inventory they used to carry, which would have covered those sorts of positions, they really can't afford to carry anymore. And so the market is, in my opinion, less liquid than it used to be. And on top of that, you've had much more issuance. So that can be a concern. As a lender, I always want to be aware of what the supply is in the market before I make a loan. If I make this loan, am I 10% of the supply, or am I 20% of the supply, or am I 50% of the supply out there? Because what happens if my client wants those bonds back to sell them, as Salah talks about? And as an agent in this business, I think there's a responsibility there to understand the liquidity of the underlying asset. So I think that is a valuable point to make. So thanks for doing that, guys. Some great contributions today. The risk, in my opinion, is very low, but it is a real risk. If anyone tells you this business is risk-free, move on quickly, because that's just not reflective of reality. There are risks. And so the question you should be asking is, what are those risk mitigants? So the bottom line with suitability is it's not for everyone. But interestingly, the more participants that there are in the business globally, the better it makes it for everyone, from a liquidity, from a recall coverage perspective, and maybe not so much from a revenue perspective. Although, again, I'll talk about all of that in another video because it'll take us quite a long way off track. But suitability, not for everyone, but at least should be considered by everyone so that they come to an informed decision whether to participate or not. As I said, I've talked about risk. Those of you that watched it last week, you'll see that in the 32 videos, I did 2 pieces on those are the topics I covered on those, so I won't go into that again. But fundamentally, the risk reduction mechanisms here are choosing your counterpart so you can be selective about who you will deal with and who you won't deal with. First of all, in order to even have the potential for a loss, a counterparty has to go out of business. Secondly, the collateral that you hold from them is your next line of defense. And that should be, if you're working operationally efficiently or your service provider is, the collateral should be enough to cover all of your risk, or if not all of your risk, at least the overwhelming majority of your risk position. So that if you have loaned $100 of stock and you've taken $105 of collateral and your counterparty goes out of business, you have that $5 buffer. Now, because of market movements, that might be compressed. So if that 5 goes to 3, that's still okay because you're covered. If it goes to 99, then you have a potential problem, but you only have a potential problem on the $1, not the original $100 of your loan. Okay. And then finally, many of the service providers in the business here that work for investors that are lending may provide an indemnification. So that's your third line of defense there, where they say, look, even if that transaction that was 100 and 105 goes to 199, and you now have that $1 exposure, don't worry, as your service provider, I will cover that $1 exposure. So risk is real. There are mitigants. You need to understand them. But again, relative to just market movements, that's a pretty low risk, in my opinion. Of course, generates a smaller return. So life's a series of trade-offs. So that's risk. I do come across particularly product managers from time to time at some asset managers who think that by not lending, they have got a unique selling proposition. That's their USP. We don't lend. And why don't they lend? Well, lending's unethical, which we've talked about. Lending is risky, which I've just talked about. We need daily liquidity. Now, to me, that's a reasonable comment. And in many cases where you actually talk about retail funds like mutual funds, like UCITS, regulators in many countries put a cap on how much of the underlying portfolio can actually be loaned out in order that those funds are better able to meet daily liquidity needs from investors that are redeeming. And in fact, I'm actually working for a customer right now where the product that they are putting together that I'm helping them with, in fact, it is a USP for them that they don't lend the underlying portfolio because they need exactly that point. They need daily liquidity to meet the needs of their investors. And so to me, that's a reasonable solution for the specific needs of that investor in that fund. So I'm not just dismissing it out of hand. I think each of these points needs to be considered. One of the things I have heard an asset manager say is, well, our competitors are reckless. Look at the collateral they take. Look at the markets that they're in. Look at the liquidity. Aren't they terrible? And my answer to that is, well, in your opinion, maybe. But if you feel that strongly about it, maybe what you should do is say, we lend, but here are all the key features from our program that make our lending program better. And there you're actually competing. So just saying that your competitors are reckless, to me, is a useless comment. Not that I want to be judgmental. Well, I do. And just a couple of points on at the bottom here, a note and a question. If two funds that follow the same index benchmark have similar portfolios and one is lending and the other isn't because they think it's a USP, it's likely that the one that is lending has generated some additional alpha. So the performance bias will be in favor of the one that is lending. And the real question I want to leave is for that investor or that product manager or that investment manager that says we don't lend and that's our USP, has it actually added more investors into your program? Have you actually attracted money away from your competitor because of your USP? I can't answer that, but I think it's a question that people should consider for themselves. I have a question here from Javid. You weren't aware that I had a YouTube channel and you have now subscribed. Apparently, I now have 409. So thanks everyone that's signed up. It's been a busy morning, but yeah, look, I'm not bad at self promotion, but telling people about my YouTube channel, maybe that should be added to my goals for 2022. I'll make a bigger deal about that. So look, that's the product differentiator USP comment. And then finally, I guess really it's about the knowledge or lack of knowledge out there. As I say, I've been talking to people about this business for decades, and so have many other people. And the reason that there's 28 trillion euro of assets available today is because we've been largely successful. We have been able to get the word out. I think competitive pressures have driven some people into the business who had been outside of it previously. I think regulations have made people feel more comfortable about it over time. I think the scrutiny after the global financial crisis and in light of the Lehman default, I think that as hard as that has been, it added some real insight from regulators and other interested parties. And because of that, many of the layers of opacity have been removed. Now, not all of them. And we see the SEC consultation really about trying to improve transparency in the business is yet another step. There is the global principles for sustainable securities lending, which I'm a part of, where transparency is really at the key of it. So we still believe there's more transparency that's required. But I think the degree of openness today is incomparable compared to what it was in the past, where people didn't really even admit that they did it publicly. I think knowledge has improved and they understand. Again, ethics is part of the question because I do think that there's an ethical case that, in fact, we have better markets that are better informed, and you're more likely to have companies that are bad actors and investment managers that are bad actors be called out by short sellers. And that is only enabled by securities lending being able to feed short sellers. And so I think we have a better market ecosystem because of it. And that's why so many exchanges have joined since the global financial crisis, when you would think that that countries would be opting out of securities lending. In fact, the opposite, more and more countries are facilitating it, and the index benchmark providers require it in order to be even an emerging market, let alone a developed market. Yeah, I'm not certain who the LinkedIn user is that made that comment, but just share it. Most definitely, transparency has come leaps and bounds over the past 20 years and will only get better. It doesn't tell me who you are, but I couldn't agree with you more. So thanks for sharing that. Risk, we've talked about risk. And again, risk is something where we understand more and more about it every time. Unfortunately, risk improvements typically come as a result of market crises. But again, what I'll point out is that there have been very few losses over my whole career in securities lending. And where there have been losses, it's usually been because people have been too greedy. So maybe not too different from many parts of life. Regulation, not only do people draw comfort from the regulations that have come in, I think regulators themselves know a tremendous amount more about the business than they have previously. There's always an opportunity, right? This is about a revenue-oriented business. This is about adding small bits of incremental revenue year after year. The alpha just accumulates, right? If you only have positive income year after year, it doesn't matter so much that it's actually small, because cumulatively it makes a huge difference. I think competitive positioning really has been the driver, though. That's really what's forced more firms to look at it and decide whether it's right for them and whether they can exist in a market without being engaged. And I think that will be the biggest driver to further participation and getting that number up from 28% to a much larger proportion, or at least that's my hope as well as my expectation. So really, knowledge, again, if transparency's come a long way, I think the communication of the business and the reality that is made much more accessible by the transparency, I think that's what's transformed the activity. So even that 28 trillion, you'll see that has come along pretty quickly as well in recent years. But of course, this is usually the spot where I put in my courses. So I haven't put in the courses today. I've replaced it with this slide. One of the things that we do, because if you're not in the market, how do you get information? Usually you get information because one of your potential service providers makes a pitch to you and says, look how much money you can make. This is what we would do for you. And look, wouldn't it be great if we could make money together? And while I believe that they are genuine in all of that, the truth is they have an interest. They have an interest in signing you up. So one of the things that we offer as Pierpoint is we offer insights for non-lending institutional investors and trustees. So it's a free of charge assessment by the team here of lending opportunities, the potential income, and the issues and challenges that you might face. So if you're interested in learning more about that, maybe just put a comment in the field after the video is processed, or alternatively, you can just email me. And I think I have my email up here. Yeah, Roy@Pierpoint. There you go. So if you're interested in learning more, just send me an email and I'll send you some information out there. Of course, there's always fine print. So as this fine print says, this is really only for institutions and brokers and not retail individuals. Unfortunately, I suggest you speak to your service provider for that. Many brokers, an increasing number, are actually making securities lending and borrowing, to be fair, accessible to their customers. And again, I think that that's a good thing. So that's the insights, free of charge. Let's just do a summary of where we've been today. So ethically, that's a reasonable question and it's an individual choice. But what I really encourage everyone to do is have an informed choice. Don't just say, oh, that securities lending thing, I know it's bad, I'm not going to do it. That's, to me, not really exercising your fiduciary responsibilities. As far as suitability, it's not really for everyone, but it is for many. And I would argue that it is for many more than participate today. We look at risk. Don't forget there's a waterfall of protections against the very real risk that exists with the business. But again, it's about a low risk for a reasonable cumulative return over time. As far as product differentiators, the key takeaway I'd give you there is that there's no question about it. You end up with a competitive performance disadvantage if you are competing against someone that is lending. Doesn't mean that you should participate, but it does mean that you need to take it into consideration. And then finally, as far as the knowledge about the business, the truth is out there somewhere. Always engage with a professional advisor before involving yourself with securities lending or any other activity in the financial markets. These are crazy markets and you need to be well informed before you participate. I think there's consultants out there. I know one. So that's it for this week. Next week, we're going to be talking about bilateral collateral versus tri-party collateral. Amel, as I said earlier in the program, suggested that a while ago. I've been trying to schedule. This is the first opportunity I've really had to get it in. Really inconvenient. Christmas and New Year being on Saturdays. I'm hoping they'll sort that out and we won't have the same thing again in 2022. I think that's been worked out. Javid, just a quick question here, I think. Do you think the charges that will be levied on both loans and return transactions for the late settlement as part of CSDR will impact the borrowing and lending appetite in any way? The reason that's a super question. One of the reasons, in my opinion, for the introduction of fail penalties is because the markets used to be self-regulating in the sense that when you have a normal interest rate environment and your counterparty fails to deliver to you on time or fails to accept your receipt, there used to be an incentive to claim from them and have them bear the cost of their inefficiency. With interest rates at basically effectively zero for so long, a lot of that market discipline has gone out. So one of the reasons that regulators, I believe, wanted so much to have penalties in place and then buy-ins on top of that, which have been delayed. The penalties are there really to take the place of the normal interest rate environment market discipline. And if you look what happened with the U.S. with the settlement of U.S. Treasuries, as soon as they started bringing in standardized accepted penalties for failed transactions, they literally disappeared overnight. So I think, first of all, that people will be more disciplined in their efficiency, and that might lead to some short-term borrowing and lending opportunities there. But again, that's not going to make you rich because there's such short-term transactions, hopefully, and the settlement costs eat a big piece of it. I think it will increase volumes, but I don't think it's going to make anyone rich. But look, it should rise, as will the movement from T+2 to T+1. I really believe that a lot of the continuous netting of settlements that happens in the market and the recycling of securities, the problem is when you move from 2 days to 1 day, there's a lot of that market turnover that doesn't get a chance to cycle through the system. And that's certainly been one of the points that have been raised about same day activity. But look, I think that's a genuine issue. And so I think settlement movements are very similar in that way. There will be a need for more activity, again, for shorter periods of time. Thanks very much for the question there. Look, it's been fantastic. We've had a bunch of new people in today. I hope you got value from that. If so, again, give us a. Otherwise, that's it from me. Have a great Saturday. Have a great weekend. Have a great week. And I look forward to seeing you next week. Thanks, everyone, and over and out.